forward. Venugopal Garre, Managing Director with Bernstein, joins us now. Venugopal, good morning. Thank you for joining us. Let's understand with your view of the world. Exactly a week ago, the concerns for equity markets were abundant. China, US macro data, and Middle East crisis. At least for the moment, two out of those three concerns have taken a backseat.
Yeah, so I think we need to be a bit more concerned about India's own drivers rather than what has happened externally, in my view. So if you were to just think through, my concern externally is not really much linked to China, because I think the China recovery, for whatever the reasons be, is actually positive for India, not negative for India, in my view. We can discuss that, but that has been my stated view. Middle East, broader concerns as to what could happen to crude and commodities in general, it's something that we need to watch, because that's going to be very volatile and could shape up very differently from what one would want it to expect, or expect that to happen over the next couple of months. So we still need to keep watching that aspect quite closely. But I'll bring us back to the broader India perspective itself. I guess we are going through potentially some phase of fatigue in the economy, as I said, and that is something which is going to impact earnings as well. So we need to watch more for that as a challenge for capping Indian equity returns than anything else.
So let's talk about specific of India, since you've flagged it off and you've been writing about it. What are the indicators which are telling you that things are moving from growth to slowdown, or growth has plateaued? Give us three examples or indicators which are giving you a sense that things are now plateauing out.
Yeah. So very top down, I would just highlight that since data is broadly on the macro front, pretty closely tracked. If you were to just look at the two main drivers, or three main drivers for the economy, one was government Capex. Government Capex data clearly suggests a pretty material slowdown over the last couple of months. And that data is, of course, available. Yes, there would be some room for a catch up in second half, but then on a full year basis, I guess you still miss those numbers, because you can't really catch up on Capex if you missed spending for a couple of months. So that's one major driver sort of turning sort of negative. The second aspect I would probably say is on the consumption front. The drivers, which were largely centered around upper end urban consumption and premium, is starting to see a fatigue. Very, very clearly, you can see two-wheeler premium sales flattening out for the year. SUV sales have started to moderate compared to last year's momentum, while affordable is yet to see a recovery. While at the same time, we can see generic retail sales based on data from Retail Association and others, that's also starting to slow down quite a bit into the last few months. Now, what it means is that as we head to the festive season, you're going to see a lot of discounting appear and emerge across the board for corporates and products to ensure that you get your volume growth, right? And of course, that's not necessarily great for margins. And more importantly, if you then, build anything which are derivative drivers, be it, aspects around IIPs, production levels, and things like cement demand, or across the board, you basically see some degree of fatigue, which is more derivative in nature in terms of demand. So these eventually have to reflect in numbers, even if these are episodic and even if there are intermediate sort of fatigue factors.
Okay, so let's look at one data point which is classic: PV sales and CV sales and two-wheeler sales. While PV sales are now plummeting, two-wheeler sales are making a comeback. Why is that we are getting such a divided picture within autos, which always is the biggest and the most best high frequency indicator? Same time last year, rural India was under stress, two-wheelers were down. Now two-wheelers have come back and passenger car or PV sales are down. How should one read into this auto data as an indicator of consumption demand?
Yeah, so a very fair point. Auto data, unfortunately, is not synchronous at this juncture, partly because of the COVID-led impact in terms of what recovered first and what started to recover later. Now, if you were to broadly characterize this, passenger vehicles had sort of hit on to absolute volumes, which were higher than pre-COVID levels sometime early last year. And thereafter, still some momentum continued, but then we've started to see fatigue in general in passenger vehicle sales, which is both top end, which was a major driver last 3 years. And remember, there is no affordable recovery happening. Now, that tells you that the top 40 million households, which have been the drivers for the economy, are essentially not necessarily incrementally, seeing that kind of a momentum. That's one part of the story. The second thing is, if you look at two-wheelers in general, bulk of the demand that you see in two-wheelers is stacked up in the mid-end of the vehicle range. As far as top end is concerned, which is premium, which we call greater than 250cc, is actually flattish through the year. And that was actually quite decent last 2 years. So in theory, even if you were to just pull through the views on what is happening on two-wheelers, the top end is still not necessarily great and actually seeing a moderation momentum. And we're not really seeing any major signs of recovery in affordable as yet. So it essentially means almost similar to PVs in terms of thinking, in terms of the economic impact. CVs, just wait and watch what will happen in the next few quarters. Things are going to slow down materially from here. Firstly, CVs anyways had picked off and came closer to flattish numbers. But then what we are hearing on the ground from various fleet operators and others is going to be very bad the next few quarters at least. So you're going to see the momentum moderate even further from here.
Is it then that you're seeing opportunity or a revival in demand and Capex? I believe there are some opportunities within the power sector, according to you, that look promising.
Yes, so I mean, in a very medium-term approach, we have been of the view that government capex as well as transportation capex has peaked. It's a reality which is very hard to understand, but it is happening and it is going to happen and be visible in the next few years as well. Power capex is just starting off, which means it will be volatile. But then if you were to really position yourself towards playing the momentum around power sector, because there's a need both around transmission and around renewables, keep looking for opportunities around there. It's a 3-4 year cycle. So it's just started last year.
So,
Venu, the other thing this morning and the big talking point is the kind of disruption which is currently at play in the Indian markets with regards to Q-commerce and the kind of impact it's happening on the traditional, mom and pop kind of retail stores. And I'm talking about the backdrop of Avenue Supermarts this morning. But do you really think that Q-com is going to sort of overtake this entire space?
Very, very topical and important question, given where we see Avenue Supermarts opening today in terms of stock price. See, if you were to, I actually, find it a bit difficult to believe at an India-wide scale, you're going to see an impact on kiranas in general, at least in the next couple of years. Because it is Q-commerce was to a large extent an urban phenomena. And yes, they are looking at tier 2, tier 3 as well. But if you just look at the size construct, the entire quick commerce market is probably a couple of $1 billion, $2 or $3 billion. It's sub $5 billion. It's primarily a $500 billion grocery TAM in India, which is the actual sales or retail sales, and $1 trillion retail sales in India overall. So I really don't think that at where we are in terms of Q-commerce, it is going to be that big or that impactful in terms of overall India kiranas. The second thing is for someone like organized retail. Organized retail itself is very small in India at this juncture. And they are impacted because they're trying to buy the same customers, especially in urban areas. So it does impact your mature sort of retail outlets, which were originally commenced in some of these urban areas, right? So, but then they do have an opportunity to scale up quite materially in tier 2, tier 3 and beyond, which is what is going to be a positive driver for them going forward, because they're going to displace kiranas in a tier 2, tier 3 from a value construct. Third thing, remember, is quick commerce is convenience. It's not value. And it is hard to believe that you're going to see quick commerce. By the way, we're positive in quick commerce. I'm still saying that. It's hard to believe it will be $50 billion in 3 years, right? So it's not going to be that disruptive for the overall ecosystem to be impactful enough, because I think convenience TAM itself is relatively restricted. Indians are not rich enough to, just buy everything at MRP.
But is the bigger overweight going to be on Q-com as opposed to traditional retail?
We are very positive in quick commerce. So in that sense, some of the quick commerce names, both upcoming as well as the ones which exist, we have overweight stance on them. Now, interestingly, I do like organized retail as well. So I think this is from a pivot point of view, it's a very unique situation where we are positive on both at this juncture, right? And I think it's going to play out over time in a fairly different way, but we're currently overweight both. Quick commerce is preferred over organized retail, and both are preferred over traditional retail. So that's the way I would position it. So it's a question of valuations as well, right? So that's another thing which I don't want to discuss right now, but that's another variable that does come into equation in terms of how much returns you expect on a 12-month view. But we are overweight quick commerce, pecking order wise.
So let's go back to the headline which we were discussing, that parts of economy are slowing down. Now in markets you have to look at what is in the price, what is not in the price. So to your mind, the slowdown which you just flagged off, whether it is coming or it has already started in CVs, whether it is coming or has already started in private sector capex, how much of this slowdown is actually built in some of the pockets where you see that the trajectory is going to be south?
Nothing is priced in, believe me, at this juncture. Look at the stock prices of some of these specific sectors as well. The reality is the slowdown is not consensus yet. I've had numerous conversations post that report as well, and it was a bit of shock to people, which is both FIIs and domestically, that actually there's a slowdown. So there is no consensus yet on slowdown. Number two, the impact is earnings. First quarter earnings weren't great, but were attributed to election impacts. Second quarter earnings, when you start to see being not that great, and you're not going to be in the mid-teens sort of earnings growth for this year for the top 100 stocks, and you end up with high single digits, that's where earnings downward revisions happen. That's when stocks start to get impacted. So we are not yet seeing the impact on equity markets.
Now within the private sector capex, you said that the traditional capex is slowing down and power dominated capex is looking strong. So what is the best way if somebody has to say, okay, rather than approaching capex as a basket, I need to now approach capex as a differentiated basket. What should one look at and what should one sell if one has to play these two ends of capex now?
Yeah, so the way I look at it is anything linked to roads or railways, be careful. Anything linked to power, look at it progressively, which means that even they have gone up stock price perspective, but there is a slightly longer room for them to show the earnings momentum, right? And power could be power cap goods companies or power utilities in general. So that's a way to shape up. In the middle sits L&T, which is like a diversified player, which can move anywhere that you want it to move. And they are big beneficiaries of private capex over and above what they do, because it brings down the sort of execution periods for them, which means revenue momentum expands and margins get enhanced when they move from infra to private. So that's like a beneficiary in my sense with the shift happening. So that's where we are positioned per se.
I like to just shift gears and talk about then banks, where do they sit in? Now whether capex or consumption, whatever may be the underlying factor, if things are slowing down, credit growth will slow down. And if that is the story, then could banks which were supposed to get re-rated will remain derated?
Okay, I have a very unique situation around banks. I think they would perhaps be a beneficiary of growth recovery on a 3-year context driven by rate cuts as well. And the valuations are not wacko for banks. So there is a downside support as well. So when you worry about markets, you need to also look at sectors and stocks which may not really see much downside because they are not really frothy at that stage. So that's the way I would position banks.
You think from here, if the starting point is let's say 14th of October, in next 1 year we should expect double-digit returns from markets, or that would be a high watermark?
Double-digit returns is a high watermark.
You don't see a situation where there could be no returns or negative returns. You still expect that even at these levels, even at the current valuation juncture, the fact that there is a genuine slowdown around the corner, the markets could give you positive returns. You don't expect like a sizable downside of 10-15% from here.
Mids, but not large caps. Large caps 5% downside.
The other thing, Venu, I also want to go back to is that the point that you were making, that much unlike popular belief, you believe that if money were to flow into China, it's going to be more an EM allocation, and India will also benefit from that. We seem to have snapped that line. Okay, we'll try and get back to Venugopal Garre. Let's just...
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.